Hi, I'm Jason Scott. I'm a mortgage broker with TMG, the mortgage group here in Edmonton. So there's been two recent quarter point cuts by the Bank of Canada, and that gets people excited, and they're like, hey, fixed rates must be dropping by the same amount. That's not necessarily true. So the Bank of Canada, they have a key lending rate where they're trying to control inflation and trying to get inflation to 2% or as close to 2% per year as possible. What they do impacts variable rates. Fixed rates are based on the bond market. Now, the bond market is where a bunch of bond traders basically are trying to anticipate where the economy is going. And they trade every day that the stock market is open. And so therefore, they're way more reactive or predictive than the Bank of Canada. The Bank of Canada meets every 6 weeks and they either raise rates, lower rates, or do nothing. Every single business day, the bond market is in action. And so if they think the Bank of Canada will cut rates at the next announcement, they're already starting to price that in on bond rates, which dictate fixed mortgage rates. And so the Bank of Canada does something, you don't necessarily see an immediate corresponding move on fixed rates. They may come down a little bit. In fact, bond yields may go up a little bit depending on what's going on in news about employment or GDP growth or what's going on in the United States for that matter. What a lot of people don't realize is the United States has a huge impact on Canadian mortgage rates. My job is to find you the best mortgage for your scenario. So feel free to give me a call, 780-720-2490, and be sure to subscribe to my channel.